All right, perfect. So thank you guys all for joining us this morning. Today's market update, first one of the year, and perfect topic for that is start the year off right. So we're going to be looking at how the markets are currently performing, kind of some predictions and things to look at in 2022. And then we're also going to look at the new contribution limits that have been put in place for this year. Okay, so I'm sure a lot of you guys know there's a lot going on right now with the markets. And if you guys can see my screen, hopefully it's still there. I lost the little green bar. You guys still able to see the screen? Okay. So current market returns. We've had a rough start to the year. Kind of a good start initially, right? S&P hit the all-time high earlier on in January, and since then, it seems like everything's just kind of going a little crazy. So here are the current market returns with everything. This was as of close yesterday, the 27th. So the S&P was down almost 10%. So it's almost entered into that correction territory. The NASDAQ, which is a tech-heavy index, is down. It's getting hit the hardest out of all the indexes right now, down almost 15%. Dow Jones, as you can see, which tracks 30 of the largest companies, down 6%. That has some technology, but also a lot of value type stocks. And then we have the Russell 1000 growth, which is down again, tech heavy, down 14%. And then the value down almost 5%. And even bonds right now are down. A lot of pretty much everything is down right now. So why is that? There's a lot of uncertainties going on in the market currently. So a couple of those factors right now are inflation. Right now we're dealing with high inflation across across many different sectors, which creates a lot of uncertainties. Inflation historically will impact technology stocks the hardest, and so that's why you're seeing the NASDAQ and all of those indexes that track higher technology companies. That's why you're seeing those being hit the hardest, because of all the inflation that's going on. Inflation going forward, it will still be there. Hopefully it will be slowing down throughout the year, but that remains to be seen. Interest rates. This is one of those things that will affect the bond portfolios the most. You see the AGG, the bond index, which was down just north of 3%. That's getting affected because of all the uncertainties with interest rates. The Feds have come out and they're talking about possibly raising the interest rates anywhere from 2 to 4 times throughout this year. Whether that happens or not, that still remains to be unseen. But I would predict at least 1 to 2 for sure interest rate hikes. That's another way just to kind of lower the inflation rate. So they're all tied together in one way or another. Another uncertainty that affects a lot of these growth companies and other companies are the supply chain disruptions. We've heard about this ever since the beginning of COVID-19. Things are getting backed up. And I'm sure if you guys have been to stores, you notice that. You're starting to see a lot of shelves that aren't nearly as full as they used to be before the COVID-19 pandemic started. There's been talks that it will take years for the supply chain to get back to normal. So we might continue to see, some inflationary aspects due to that supply chain disruption. COVID-19, that's a big uncertainty. It seems like there's a new variant out almost every other week, right? And so that's a lot of uncertainties there. Global conflicts. Goodness, there's a lot going on right now that there's a lot of uncertainties there as well, right? You have the Russia-Ukraine, US-China relations. There's a lot of just global conflicts and just uncertainties, and the markets never react well to uncertainties. There's always going to be periods of time, that the markets are going to correct like this. Stagflation is also something to pay attention to. Stagflation is kind of a mixture of these things. So it's when you have high inflationary periods of time, you have high unemployment and low economic growth. Stagflation is kind of a newer thing brought about in like the 1970s, but it's all three of those things kind of put together. And so that's a big concern, because we do notice that there's high unemployment currently going on, high inflation, and low economic growth. So that just leads to, again, a lot of just market volatility, and again, uncertainty that the markets do not respond well to. So as far as the market forecast in 2022, what I have up here is a poll run by CNBC, and they polled 400 chief investment officers and just portfolio managers throughout the U.S. And this was the predictions for 2022. Now you can Google search this, and you'll find different answers depending on what article you're reading. But this poll of about 400 kind of fits broadly as far as what most people are expecting. So out of the 400, 2% thought the S&P might be up 20% or more this year. 18% up 10 to 20. And the majority think that the S&P will be up anywhere from 0 to 10%. 10% think that it'll be flat. And then you have a few that are going to be more bullish on the S&P, 13% thinking it'll be down anywhere from 0 to 10. And then you have a few that think it'll be down 10 to 20. None of those managers, though, think that the S&P will be down more than 20% this year. So it'll be entering correction territory, but not bear market or crash type as far as the forecasts go. Now, pretty much every article I read, for the most part, the economists, all these managers are kind of thinking around anywhere from 8 to 9% is the prediction for the S&P 500 to close at for the end of the year, which still is and would be a pretty good year. The last 10 years as investors, we've all been kind of spoiled, I would say. All right, it's been a tremendous bull market, and it's ultimately, I think it's changed our mindset on the markets. And so when we start to experience some volatility, which is normal within the markets, right? We're going to expect volatility going forward. This is a chart going back to 1949. This is looking at the S&P 500. And this is showing that declines are a normal part. So what we're experiencing now isn't something unique to the markets. It's kind of unique to a lot of us as investors that haven't experienced experienced 2008, but it's such a long, 14 years ago was the last major correction. Of course, we had the COVID correction, but that was more of, I think, a market reaction to something. The markets were in good positions, and I think that's why you saw it recover so quickly after that COVID correction. But 2008 was the last time where you had a sustained market correction. And so those last 14 years have been pretty amazing as far as growth goes. And so just going forward, we need to be expecting volatility. That's what the markets do. It doesn't mean that the markets aren't healthy, but it's getting them back into positions where they should be. So the size of the decline, as you can see here on the left-hand side, typically the markets will decline 5% or more, about 3 times a year. And the average length before you return back to normal is about 43 days. Okay, 10% or more. This happens once a year. So we've hit that. The S&P did drop a little bit below 10%, but it recovered slightly to about that 9%. Again, that takes about 112 days to recover from. And then 15% or more, that's about once every 3.5 years. And then 20% or more, it's about once every 6 years. So we haven't seen a lot of these 15 or 20% declines that the markets have seen historically. Again, the last occurrence is shown February 2020 for all of these. That was the COVID correction, as I call it. But that wasn't necessarily due to any underlying market factors. Again, I think that was just a quick reactionary thing to a global pandemic. But the markets, again, they were in good positions there. And so we truly haven't seen that internal market correction of sorts that you would expect to see You know, a 20% drop once every 6 years. It hasn't really happened since, you know, before 2020. It hasn't happened since 2008. So we're a little bit behind on you know, that typical decline. So I would expect, again, going forward, that the markets will continue to be volatile, but expect that as investors. You know, so what do we do for that, and what lessons have we learned? Well, number one, nobody can predict the market on a consistent basis. Nobody will know exactly when market declines will happen, right? And no one can predict how long the decline will last. For instance, the COVID correction, that was the quickest decline, quickest drop in the markets, and then the quickest recovery that they've ever experienced. But again, that's not a guarantee that going forward, the markets will recover from corrections as quickly as it did during that time frame. No one can consistently predict the right time to get in and out of the market. Market timing and market timers, it just doesn't work. And so some of the things that you can learn from that is, number one, don't sell on emotions. That's one of the worst things that you can do as an investor, is let your emotions get the best of you. And if something drops a little bit, then you sell out and try to find something else. Follow your plan, have a plan, know your plan, know what you own, and follow those things. We use a risk software called Riskalyze. If you guys have not taken one of those risk tests, we recommend reaching out to us, and we can send you a quick test just to kind of get your risk tolerance and see if your current portfolio is within that range still. That's very important. Now, I love this picture that I have on this slide here. Our registered investment advisory firm just held a quarterly advisor meeting, so I stole some of these pictures and one of the slides from them. So a little shout out to them. But this is amazing how we think of as investors, right? On the top one, you have somebody doubling his money. It's going from $10 to $20 a share, and he's as happy as can be. But then on the bottom, same thing, starts at 10, goes up to 30 and ends at 20, but he's miserable, right? If we shift our mentality, and even during these market corrections, if we look at our portfolio as a whole, if we're still up, then we're doing well. We're in good position there. But it's just pretty cool how our emotions tend to get the best of us when we end up in these volatile market situations. So time is your friend. Now, we utilize in a lot of the portfolios we use separately managed accounts, which are where you own the individual positions. They're tactically and active managed. So the investment bank, R.W. Baird, they examined top 5 of all performing equity funds over a 10-year period. So 155 of the top fund managers, and they looked at their performance. And it's interesting to see the results of these top managers. So in about a quarter period, only 54% of these top fund managers outperformed their benchmark. Okay, so that's not much. You're like, well, I have an active manager or this tactical manager that is supposed to be, the best of the best, but they're not doing great right now. But the longer that we hold on to these top positions, or these elite funds, the more and more outperformance you start to see. So as an investor, it's smart to have, you want to be aware of what's going on currently in your portfolio, but it's also smart to and wise to have that long-term outlook as well. Because in that long term, that's where you start to see the outperformance of these fund managers, or these separately managed account managers. You start to see their worth. You go out to a 7-year window and you start to see that now 94% of these managers are outperforming their benchmark. So pretty amazing thing there. And one thing that you're going to notice now with these managers and the type of assets is you're going to see a shift or a trend. Typically during high inflationary period times, you're going to see certain sectors or things outperform others. Growth positions or growth companies have outperformed tremendously since 2008. If you think of the FANG stocks, your Facebook, Apple, Amazon, Netflix, Google, we'll throw in Microsoft and Tesla. If you were not in any of those holdings over the last 10 years, you missed out on a tremendous amount of growth. But now that we're starting to see all these other uncertainties that I talked about earlier with the inflation and interest rates, technology is getting hit hard. Value stocks right now are typically in favor. When inflation is high, these value stocks, companies like McDonald's and Walmart, you have different other companies that are in the value sector. They tend to outperform in higher inflationary periods. Number one, because those are things that we still need, right? We still have to go shopping for food. And so the profit margins in those businesses aren't hit nearly as hard as the profit margins in like technology type companies. And so just be aware of what you own and know that, if you're not needing this money short term, you have that long-term approach, knowing that over the long periods of time or over longer holding periods, that the outperformance will be there. So even though one of the managers that we use, they're down pretty decent this year. If we go back to the beginning of the inception, since we started using them, they're still up 8 to 9%. So they're still doing their job even after experiencing some volatility. They're still up, and we'll continue and expect to see that growth going forward. Now we'll jump real quick into contribution limits. Just kind of close things off today, and if you have any questions, feel free to input them into the chat box. Very little's changed as far as the contribution limits, unfortunately. Traditional IRA and Roth IRAs, there's no changes to any contribution limits there. So no changes in 2021, and those numbers have stayed the same since 2019. We're hoping to see some type of increase there, but no such luck. So you're still stuck if you're under 50 at a $6,000 limit for any traditional or Roth IRA. And then if you're 50 or older, you have that $1,000 catch up. So a total of $7,000 contribution limit there. Now, if you want to contribute to a Roth IRA, just be aware that there are income limits that may either reduce your ability or completely eliminate any contributions to a Roth. One of the things that is possible is a backdoor Roth IRA, where if you make too much to contribute to a Roth, you contribute to your traditional and then do a conversion to a Roth IRA. There's been a lot of talk about those types of backdoor Roth IRAs within the government. They're talking about possibly getting rid of the opportunity to do that altogether. Again, that's one of those things where they feel like it just benefits the wealthy more than it does, the middle to lower class. 401ks, 403bs, 457s, any other type of ERISA sponsored plan. This did increase a little bit for this year. So you're allowed to contribute $20,500. And then if you're 50 or older, you have a $6,500 catch up. That's up $1,000 from last year. So 2021, the max was $19,500. So some growth potential there. Simple IRAs, $14,000 is the max contribution with a $3,000 catch up if you're 50 or older. That's a $500 increase from 2021. So good there. And then the SEP IRA, they're very different in the way that they work, but you can contribute up to 25% or 25% of your net earnings up to $61,000, which is a $3,000 increase from 2021. So some growth there across the board. Just unfortunately, the traditional IRAs and Roth IRAs are still capped at that 7,000 max if you're above 50. Now, as far as the earnings limit, this is important to know for all of you that are close to retirement age or retirement eligibility at 62. Just be aware that Social Security, there is an earnings limit. So this is if you file before your full retirement age and are still working. Those numbers have increased a little bit for 2022. So if you're under your full retirement age, 19,560 is the most that you can make per year before, and this is if you file. Say you file at 62, the most you can make is 19,560. Now this is earned wages. This doesn't look at your pensions or investment income, anything like that. This is just earned income. So you're capped there. So every $1 that you, or every $2 that you make above that 19,560, they're going to reduce your Social Security check by $1. Be aware of that because Social Security doesn't always catch it right away. But when you file taxes and things like that, they start to see. And so you may not be working at the time and you may be depending on that Social Security check, and the Social Security Administration may say, sorry, you earned too much. So now we're withholding, a certain amount of your Social Security payments until they're made whole because of that earnings limit. Now it does jump up the year that you turn full retirement age. The income does jump up to 51,960. And then for every $3 above that, they reduce your Social Security check by $1. Now, there are some unique rules with that. If this is of concern, reach out to one of the advisors. And that honestly is pretty much what I wanted to cover today, as far as the markets go, and then just the new contribution limits is just looking at how the markets have started off this year, a little shaky. We've seen some of the largest intraday changes. Was it earlier this week or last week? I think the Nasdaq started down almost 5% and actually ended the day positive. It ended up, up 0.75%. So we're seeing a lot of this intraday volatility as well. And we've seen the opposite where, the markets have been up 2 and 3%, and then they end, within the last hour, there's a huge sell-off and the markets end up down 1 or 2%. So a lot of volatility, expect that going forward. But again, know what you own. If you feel like you're in positions where it's a little bit above what you're comfortable with, reach out to us. We can get that risk test to you and make sure that you are invested in your comfort zone, because we don't want to have anybody exposed to something that they might not be comfortable being invested in. Other than that, just here's the disclosures with everything. If anybody has any questions, feel free to put them in the chat box, and we would be glad to answer any questions. So I'll just keep it open for just a few minutes there. And other than that, everybody have a great year, and stay trucking along.